Good afternoon, everyone, and welcome to HKA's family of webinars. We're going to get started in just about 60 seconds. Look forward to talking to you soon. Good afternoon, everybody. This is Bill Kruse of Kruse and Associates. I'm the managing partner. We find ourselves really getting close to the end of the year, thus entitled the current slide in front of you, the 2021 year-end legislative and tax update. Now, the first week in December, we're actually going to, we believe by then we'll actually have some additional news on legislation that's pending or working. The Budget Reconciliation Act is sitting there ready to go. So I think they're tweaking a little bit. We may have some more information then. But this is kind of a precursor. We've had a lot of conversations with our clients and with other professionals and advisors about what could happen, what appears to be spooling up to happen going into 2022. And so what this is meant to do is to really consider what should our clients and what should your clients as financial advisors, what should we be doing with our clients or helping them with at 2021. It's getting a little late, right? But in 2021, getting ready for 2022. On the call with me now are Jordan Coolingle. He's a limited partner with our firm, and then Catherine Kruse, both of them ready here to add some color, to interrupt me if necessary, if I'm going too fast or miss something or ask some questions. And then always to be available to take that phone call and help you with your client. Or help explain something that I've said in the presentation. So as normal, if you have a question, there's a hand raising function in Zoom. You can ask a question directly, you can chat directly with Jordan or Catherine. If you want a copy of the slides or any of that kind of stuff, all you have to do is ask for them. We're going to go through this pretty quickly. Should be in the 30 to 40 minute time range. Don't know exactly how I'll wind up, but that's kind of the hope right now, so that you have time to maybe consider it and then get about your day. So Catherine, anything that I need to bring up that I haven't so far before I get started?
I know, just like Bill said, if you have a question, feel free to send me a chat, or you can click on the Q&A button at the bottom, and I'll be sure that those questions get answered. Thanks.
All right, terrific. So let's get started. So I got a quick agenda here. The infrastructure bill, we're going to talk about what's been passed and what is impacting us right now. We're going to talk about what the tax brackets are for 2022. People say, wait a second, we don't know. The bill hasn't been. No, we do know. The IRS has already published what the inflation adjusted tax marginal brackets are for 2022. So we're going to talk a little bit about that. We're going to talk about the reconciliation budget bill that's sitting out there right now. It's called the Buildback Better Act. And so we'll talk about the tax impacts from then. And then that leads us then into what's the net effect of all the stuff we've been talking about. So that's kind of how we're going to hit it today. So the infrastructure bill, much lauded, $1.2 trillion spending program, $545 billion worth of new programs. The next one's kind of an interesting thing. If you've been doing the math and reading Forbes, Wall Street Journal, really anything that says here's what's in the infrastructure bill, what you find out is it doesn't add up to $1.2 trillion. And that's because there are $545 billion worth of new programs in the bill, but $655 billion worth of current program fundings, which had really already been agreed to and already passed into some form of legislation, but needed some final bill to just get it inked. So half of this has already been discussed all year long. And so I don't have a lot of great detail on that. But we will in just a second. We'll talk about the new programs and then how it's paid for. You can see there's a shortfall. We've got $415 billion worth of recovery. We're going to get money back somehow. And here's the last one. There's no new taxes in here. That's kind of what's an interesting thing. Now, if you read the legislative comments about the infrastructure bill, everywhere it says, I won't vote for this if it's not tied to the second, right, the second shoe that drops, which is the Buildback Better plan, okay? So they are tied somewhat. I don't know exactly how legislation does that, but this bill is largely unfunded. So funding mechanisms for this bill will have to come then in the Buildback Better plan, which we're going to talk about. So here's what the infrastructure bill looks like in a big picture scenario. We're going to add into roads and bridges, the electric grid modernization. There's a lot of electric clean energy stuff built into this $544 billion. And this is kind of what it gets you. Wastewater is big, especially in the northern part of the country, right? Where we've got a lot of lead contamination issues that are going on. We've got a big plan for the rivers and waterways to help clean them up. Including this big one, the Great Lakes Restoration Initiative that has been ongoing for a number of years. There's $1 billion in this plan just for the Great Lakes Restoration Initiative, which really kind of kicks it off. You've got passenger and freight, especially the Amtrak Northeast Corridor. Now that's just $66 billion for just really, it's already going to go just for the Northeast Corridor, where really Amtrak is actually used on a daily basis by a lot of commuters. Internet access, these are grants. So this isn't actually money going out the door. These are grants that rural communities will need to request in order to get an upgrade in their internet access points for those communities, counties, really it'll be a countywide basis. The modernization of the electric grid is really about new lines, about this carbon capture thing is a big deal, and then some clean hydrogen technology. There's not a lot in that bid for new windmills and a whole lot of new farm, like solar farms. This is mainly for upgrading the existing system. So $544 billion. Here's how it's going to be paid for. This is the $417 billion. You can see the shortfall number. It's going to be paid for by a number of ways where Congress has really started gathering back in the money that hasn't been spent. The pretty public thing about the COVID jobless benefits, Missouri started this early on where they discontinued the uptick in unemployment because of COVID. So that's going to bring $53 billion. And this is a formal action by Congress. Once I put money over in this bucket, I have to then do a formal action to get it out of that bucket and put it back, even if it's not spent. So you can see that the COVID-19 economic relief, not spent, unspent, PPP money, unspent, right? All that stuff. So you got about $280 billion worth of stuff that we set over there, and then it wasn't spent for COVID-19. That's actually pretty good news from a country perspective. So then where's the rest of it coming from? Where we're going to go on the offensive here. We're going to go get back the things that people have taken and they shouldn't have. And that's your unemployment benefits, cryptocurrency, and then just overall tax enforcement. That's another $80 billion. So roughly going to try and harvest back $417 billion worth of stuff that's already been approved, already sitting out there, theoretically already paid for somewhere, but that's how we're going to help pay for this thing, is use this $417 billion of unspent monies. The shortfalls is $777 billion. That's going to have to come in the next law. So what I hope you heard from that was we're paying for this very, very large infrastructure bill by spending money that has already been appropriated, already allocated to something else that was then not spent, and is in essence just sitting in the government coffers waiting to what do we do with it next. So we're going to bring that back in and reallocate it somewhere else. We're not taking care of everything. This is the first piece. Remember, the infrastructure bill, most people voted for it, saying they would not vote for it unless there would be the second bill, which is Build Back Better. We'll talk about it in just a minute. So here we are with the tax brackets. So the IRS on an annual basis, because all tax brackets, it's really not the taxes themselves. So you still got a 37% bracket. It's the marginal bracket. It's what's the gap between the top, the top of the lower rate and the bottom of the higher rate, however you want to do it. What is that? That gets inflation adjusted. And really what it does is it starts spreading those brackets out a little bit so that if you re-inflation adjusted, they go back to the original law. That's really what the concept is. And we're going to talk about some of these raises, like the standard deduction that's now going to be $25,900. This is what everything looks like. Yeah, go ahead, Jordan.
I was going to say, I think one common misconception, which I feel like I talk about almost on a weekly basis with clients and potential clients, is how actual tax brackets work. So a lot of people think, okay, I've made $330,000. I've tripped the 24% bracket, and now all of my income is taxed at 24%. What you want to think of it as is your income is basically a bucket of water. You're going to first fill up the 10% bucket with everything that you can. Then you'll go into the 12 and the 22. So you fill everything up, all those brackets as you go, which is why these marginal spreadings based off inflation that Bill is talking about actually matter versus just that trip method, which is the common misconception.
Correct. And that's what this grid you're looking at right now kind of helps us through. As you can see on the far right, there's a title called marginal rate gaps. There's the 22 gap and the 21 gap. So between the lowest 0 and $19,900 for 21 in 2022, that 19,900 is 20,550. So we're increasing the gaps. So the spread is increasing. One of the things that may happen, but not under any legislation that's planned right now, is this touted new with the 39.6% bracket replacing the 37, is that all those brackets get smushed back down again, so that the 0 to 10% bracket is no longer capped at 20,550. It's going to be smaller. Okay, so you're going to kick into the 12% bracket faster if subsequent legislation impacts the actual tax rates that are being charged. But this is the way it looks in 2022. It's already published by the IRS. This is because of inflation. You can see, once again, on the far right hand, how the gaps between each one of the brackets is growing. So there's $216,000 worth of room between the 32 and the 35% bracket, and then et cetera, et cetera. So each one of these are a little bit different. And what I did here was I threw this up here. So if my taxable income is $700,000, that's taxable income, you can see here that my actual tax rate went down by a couple of $1,000 from 2021 to 2022. And that assumes, by the way, spoiler alert, that the Buildback Better is passed. And that's for the vast majority of Americans. The vast majority of Americans will see actually somewhat of a tax rate decrease in 2022 under all both existing legislation that's been passed and the big piece of legislation, the budget reconciliation bill that's going to be passed probably very soon. So that's not a bad thing. Our standard deductions are going to go up. There still is no personal exemption, okay? But now here's our gaps too on long-term capital gain in both 2021 and 2022. So things that we can plan with, and we talked to this a lot with clients in the not too distant future past. Yesterday, in fact, we were talking about going ahead and filling up those bottom brackets with capital gain harvesting, considering how do I fill up those bottom brackets with some Roth conversions. We'll talk a little bit more about this, but these are the spreads for each one of them. Short-term capital gain still taxed at the top marginal tax bracket, or you're really not the top marginal, it's at your tax bracket. So what that means is that the short-term capital gain, if you slide it in there, if you've got $600,000 in total income, including short-term capital gain, you're going to get, some of it's going to be taxed at 35%. I put in 37% because that's the top tax bracket, but short-term capital gain is still taxed as though it were ordinary income. Okay, so we're going to get on into the next piece. This is a big one, the Buildback Better. I can't hardly say it. Don't try and say that 3 times fast. And this is the Budget Reconciliation Act. Now, we first started talking about budget reconciliation in the spring, because what happened at the end of Donald Trump's period was he never did a budget. he never did a budget, and he never put a funding bill to Congress. And as a result of that, the Democrats were able to put together the big $3 trillion bill that went through in the spring of 2021 using budget reconciliation. Now, here's what his reconciliation is, depending on the House of Congress. But in this case, it's most important in the Senate, where it takes a majority to pass anything. Okay, and if it comes to funding, it takes a supermajority, 67%. Well, under budget reconciliation, the law allows one time per year for financing bills who finance budgets, etc., to be passed using a simple majority. And that's important when you've got a state Senate that's basically 50-50. So they need budget reconciliation to get major tax laws passed right now. Okay, it's actually been used quite a lot in the history. So it's not like this is some new thing. No, this is something that pretty much every administration has used for the last, well, since Reagan. It's been used by pretty much every administration to get some tax bill passed. So this is what Build Back Better is: $1.5 trillion in new taxes, netted by $500 million in new tax credits. So net, they're going to raise $1 trillion of new revenue to pay for the $1.5 trillion we just talked about spending over from 2022 to 2031. Okay, so over this 10-year period, that's what this bill does. We're going to raise $530 billion from our individuals, $460 billion from corporations, $120 billion from tax enforcement. This is an increase in IRS expenditures, in IRS manpower, and IRS really searching for people doing the wrong thing. The Trump administration had passed a pretty sweeping Medicare drug payment plan overhaul. And basically that was meant to reduce or make drugs more affordable to our senior citizens or our citizens that are on Medicare. And so what they've done is they're going to delay that until post 2031, and that's going to save $250 billion. So that's a big plan. And then there's going to be $150 billion from other, and I love that. The federal government is so big that $150 billion that's just the other. We don't have to talk about that. So this is what Build Back Better is. This is how it's going to raise its money. The important thing for us to know about that, and I'll go back to this real quick, is that Build Back Better, there's no new taxes here for pretty much anybody, whoops, keep doing that makes less than $10 million, okay? Which means that, what all this means is, these tax brackets right here, even after Build Back Better has been passed, these tax brackets are still in effect. One of the most significant things is, with Build Back Better, effective in 2021, right now, we are capped at our itemized deduction for state and local taxes. Effective in 2021, that rises to an $80,000 cap. Well, that's a large tax deduction for the vast majority of Americans. So once again, all the fear talking about higher taxes, and I'm one of those guys. I'm waiting for that next shoe to fall. When are the higher taxes coming? Because we got to pay for this stuff somehow. There's nothing's happening right now in the foreseeable future. Okay, air quotes. Something could happen that we don't see coming right now in front of Congress is this budget reconciliation policy, which though it will raise $530 billion from individuals, it's not coming from anybody making less than 10 million bucks. It's coming from a whole lot of other people. Catherine, can you help me with that Google sheet? How do I get that put in here? I'm just going to tell you what it is. So what it is there's a surtax on modified adjusted gross income. If you make more than $10 million, there's an extra 5% tax on everything over 10 million. If you make more than 25 million bucks, and yep, there's some people in the country that do that, there's an additional 3% on that as well. So a total of an 8% surtax on everything over 25 million. If you have more than $10 million in your IRA, then you're going to get limited in your ability to continue to make contributions. And if you have more than $10 million in your IRA, your required minimum distribution is going to get accelerated. So you have to take more out sooner. And basically what they're doing is they're getting that money back into the taxation piece. I've already talked about raising the state and local tax deduction. That's called SALT. So if you see SALT, S-A-L-T, all caps in some sort of an article, that's what that refers to. And then the last thing is kind of a little bit of a surpriser, but it does impact a lot of our small business men and women, is that we're going to expand the base of the net investment income tax. Now, that's the 3.8% Medicare tax that gets tacked on top of interest and dividends and that kind of stuff. Right now, if you're an S corporation, you don't have that tax, okay? What they're going to do is they're going to expand the base of this, and they're going to go grab those corporations. So we have a lot of clients that convert from LLCs to S corps. And with this law in place, being an S corp is going to lose some of the reasons why you'd want to do it. Not all of them. So if you have clients that are S corporations, just make certain that they aren't deconverting from S corp. Okay, that's not what this is going to do. Make sure they're talking to their tax professional, or get us on the horn. We would love to help them with that consideration. So once again, Buildback Better raises a lot of new taxes, not hurting or touching anybody less than $10 million in AGI or taxable income. And in fact, everybody less than that is pretty much around the corner going to get a income tax reduction in 2022.
And Bill,
yeah, go ahead.
Just to make it clear, for the state and local tax deduction, that includes also paying your real estate taxes as well as personal property taxes if you live here in Missouri, which is taxes on your cars, things like that, as well as the taxes you pay to the state on your income.
That's right. So state and local, SALT, state and local. So real estate, personal property taxes, all that stuff now capped at 80 from $10,000. I mean, if I'm just thinking about Missourians, if you live in Webster Groves, really good chance you're not getting most of your real estate taxes deducted. Now you'll have a chance to get some more of that. So that's part of the tax bracket break. Right now, just so that we're clear with itemized deductions, and I don't have it on here, just so everybody understands, right now, itemized deductions are not limited at all. There were many proposals that were going through the year. And in fact, the president himself said he basically put together a proposal that said that you'll have an effective rate max of itemized deduction equal to 28%. So if I'm in the 37% bracket and my overall bracket, my overall effective rate for my income is 32%, I'm only getting 28% of tax deductions on the itemized deductions. You have to go back. So the Clinton administration had a big limit on itemized deductions. And then the Obama administration did the same thing, different rates, different ways to do it. But right now, just so that we're clear, everything that comes from itemized deductions and hits my taxable, creates taxable income, modified adjusted gross income, less itemized deductions equals taxable income. Right now, those are whatever that number coming off of itemized deduction is, I get a full deduction for it. So what does that mean? As a summary, the Build Back Better plan is not going to impact the taxation of anybody that makes less than 10 million. The infrastructure bill that was already passed like a week or two ago, I think it was actually officially signed November 15th, quite frankly. But that bill also, no substantive, actually no tax increases. They're quote unquote paying for that by harvesting income that's not income, but cash that has already been allocated to another program that's not used. They're going to bring that back in and go spend that. So those two main bills, budget reconciliation and the infrastructure bill, are not going to have any impact really of increasing the tax burden of anybody making less than $10 million. And in fact, it's actually going to turn around, and if you make less than $10 million, you're going to have a tax deduction from 2020 into 2021 for a couple of things. The inflation rated adjustment is going to increase the gaps between the tax brackets. And the second thing is we're going to get to deduct up to $80,000 of our state and local taxes. So big stuff coming through in 2021 and 2022. What should we do? Well, you saw that our capital gains brackets to get to the lower rates has increased again, right? So let's plan on using that. Let's make sure we're filling that up. We were talking to a client the other day that really had, when he looked at his portfolio, he was overweighted in one area, but his unrealized capital gain was so massive, he didn't know how to get it out of there. Well, right now, we don't have a reason to not pay capital gains at 15%. It's a great time to be making sure that our portfolio is right sized. And even if I get over $450,000 in taxable income, and at $450,000 in taxable income and above, my capital gains tax is now 20%. And then we have this net investment income tax, so total of 23.8%. So this is still historically low or good, let's say good capital gains harvesting. So don't let the fact that you have large unrealized capital gains stop you from harvesting those capital gains and allowing you to redeploy them and right size your portfolio. In fact, now's a good time to do it so that when that next shoe drops, we've already beat that curve. Some of the proposals are still sitting there having retroactive, but not in 2021 anymore. We're back into 2022. So that it would be very much a late year surprise if something suddenly floated out of Congress that said, hey, remember when the president said that capital gains are going to be higher effective May 1? That would be a big surprise for us right now. So I don't see that coming. Jordan, you're getting ready to say something?
I was going to say on the rebalancing for capital gains, I think it's very rare, but I have had instances with clients who I guess the people advising on their portfolio, their sole purpose was to adjust for capital gains. So whenever that supposed tax increase at the September 13th deadline rolled through, what happened was they had all these unrealized gains, and then they realized them because they were sold before that deadline. So I would just check in on your portfolio to see kind of what capital gains have rolled through, just because you don't want to be surprised that all of a sudden your portfolio has been rebalanced without you even being aware of it. So just check with your financial advisor, I think, is good advice right now.
Yeah, and most of our clients on here are financial advisors. So this is the message you're going to send out to your clients, is that we've already done some rebalancing. We may want to consider to do it. Now, a lot of planning has been going on in 2021. HKA has been at the forefront of that planning, and some of the techniques being used are SLATs, spousal lifetime access trusts, and also we've had a lot of new family limited partnerships. In both of those types of estate planning techniques, you may be bringing in new taxpayers. So historically, let's just say Bill Kruse puts in a SLAT. Okay. Now, so historically, Bill and Barbara, we pay our own taxes. Well, the SLAT may have other beneficiaries. Okay. And in that in that consideration, the portfolio that's in there, which historically has been Bill and Barbara Kruse's tax bracket, may now have other beneficiaries. So I'm spreading that tax burden out amongst other brackets. So be aware of that you may have clients with SLATs or limited partnerships, and reach out and see if there is any of that new planning. You should know, because in order to create a SLAT and then fund it, or a limited partnership and fund it, then you've got to have a new federal ID number and that kind of stuff. So you should know if that's happened. But these are terrific things to allow our clients to spread that capital gains out and really soak up a whole lot of smaller brackets. So we talk about capital gain. Once again, I don't anticipate any retroactive to May. I don't see that happening. There may be another budget reconciliation. Now, so the fiscal year started October 1 for the United States, which means that the Budget Reconciliation Act, or the Buildback Better plan, that's the only bill that can use budget reconciliation. So if they want this massive tax haul over, which was first put up by the American Families Plan, they're going to have to wait till October 1 of 2022. Now, there's nothing that says they couldn't do something retroactive in 2022, but they're not going to reach back into 2021. So that should let us know what we're doing with capital gains. Individual tax brackets, we've talked about it. Let's fill those bottom ones up. There's still plenty of reason. There's no changes on the horizon to reduce the federal estate tax exemption. Right now it's 11.5, almost 12 million bucks per person. Nothing on the horizon, but it is planned. And once again, the American Families Plan has it in there. There's other plans that say we're gonna lower that before it sunsets in 2025 anyway. So those are some things to be thinking about. But for today, we're in good shape. Lower brackets coming on. QBI, qualified business income, no change for qualified business income. Do we believe it's going to disappear in the future? Yes, we pretty much do, which is kind of interesting. My colleague Blake Will brought up over and over is that qualified business income, that phantom deduction, a 20% tax deduction for having a pass-through entity that's a small business. It it is capped at 400,000. So if they take it away, I'm impacting people that make less than 400,000. That was one of the administration's promises, that it wouldn't. So we'll see where that goes. But the reason we bring it up is to continue to draw in that, although today I can buy a piece of equipment, let's say $10,000 in my small business, and I can write the whole thing off. We have to ask ourselves if that's really what we want to do, especially if we believe the American Family Plan Act is going to get put into law. Because if ordinary rates are truly headed toward us, taking a deduction in low rates doesn't make sense. Spreading that out still makes some sense, and it will definitely make more cash flow sense to you. Now, cash is king in small business. So you have to wait whether or not the cash flow out the door for the higher taxes by slowing down that tax deduction makes more sense. But if I take a high depreciation deduction, I lose some of the free 20% QBI. So your advisor should help you weight those and figure out where that goes. Okay. SALT, we've already talked about, state and local taxes. If we see anything change here, and it would be rather celebrated, if we see anything change here, or if the Build Back Better plan is not passed by the end of the year, then don't pay your property taxes until January of 2022. Just be ready for that, okay? So an early payment, and we have a lot of clients that like to get that stuff done. As soon as they get that real estate tax bill, they go ahead and send that thing out. You may want to hold off on that until we know the Build Back Better plan has actually been passed. And I see, Catherine, looks like there's a chat function, so I'll stop here. I'll pause here in just a minute and let you take a look at that. Now, the next one is charitable contributions. Once again, unlimited. So if you're thinking about doing a charitable lead trust, still a good time to do it. If you're thinking about doing a large donor advised fund, this is still a good time to do it. How should we make them? Cash is king, but if I have unrealized gains in securities, making an in-kind donation is still the best overall, because I don't have to pay capital gains on the fair value and I get the full tax deduction for it. Last thing is Ross. Under some of the new plans, our ability, and they aren't passed yet, okay, but our ability to convert, to use the after-tax 10,000 or to do backdoor Ross will be, that ability will start shrinking or be closed or permanently you can't do it. So if we're thinking about converting Ross, okay, converting to a Ross, taking my regular IRA, which is taxable when I take out the RMD, and converting it to a Roth, you're still going to want to consider getting that done sooner than later, because many provisions are in the law which are going to prevent us from doing that in the future. And the reason is simple. We already know why, because the growth of that traditional IRA, the reason we're doing Ross is because the growth more than pays for the conversion, depending on obviously how old you are when you do the conversion. So just those are the things, that's what we call the net effect. After all the things we've talked about right now, no tax increases on people that make less than $10 million. And Catherine, I'll stop here and see if there's any questions or anything we need to address.
Yeah, Bill. So one of the questions that we got, and I'm sorry to interrupt, Catherine, you had told me to reference it in the webinar, so apologies for interrupting. But one of the questions we got was, if someone's spouse passes away, do you recommend we file an estate tax return in order to claim portability, especially with the current estate exemption being so high? I think the answer to that is absolutely. I think if you think there's a chance that that person will pay estate taxes in the future, definitely do it. I think there's also some value to, if you have something that's maybe not a publicly traded security, making sure that you have some sort of documentation for that stuff up in value. So I think that there's some benefits beyond just the portability as well.
I totally agree with you, Jordan. I think that's a good summation too. And I don't want to add too much to it, but you can't claim portability unless you file a tax return. And too often people think, well, no, I don't need to file a tax return. It's not about using the whole 12 million bucks. It's that you have some left over to use. So if some of it's sliding over to my spouse and it's unused, and the two of them together under, the plan is that probably the individual exemption for federal estate tax will fall to 3.5 million. Okay. So if the combined, my estate plus my wife's estate, the half together is going to be more than 7 million, absolutely use portability to get it reserved. Now, what happens if they do shrink it from 12, what it is, and change down to 3.5 million? Well, and let's say Bill Kruse passes away in 2021, and I've got a $4 million estate, then $8 million transfers to my wife. It's frozen. They're not, there's nothing in the legislation that says, oh, and by the way, all those portability things, they don't count anymore. That's not happening. So I may have an individual exemption of 3.5 million, but if my husband died and ported 8 million over to me, now I have, in essence, I have an $11.5 million exemption again. So the only way to preserve the exemption is by filing the estate tax. And I agree with you 100%, Jordan, especially on illiquid, highly improved stock or land. File an estate return to get that value frozen. I think that's very important, especially in light of some of the proposals that floated during the year about having this every 40 years, whatever's in a trust has to be, liquidated or calculated as though liquidated and paid capital gains on it. Well, so let's get that stuff reset if we have the opportunity to. So great question. Great question. Jordan or Catherine, any other questions we need to hit on?
I was kind of wondering, Bill, so we have a lot of clients who have recently been calling and kind of asking about a lot of this. Jordan, and maybe Jordan, you can answer this too, but what would you say are the top 3 questions that clients are calling in and asking? And then kind of as a corollary to that, if someone were to call us and say, I know I should be thinking about planning right now, but I don't even know where to start, what would your advice be for them?
Jordan, you want to take the first pass?
Yeah, so for the top 3 things that I am asked about for planning, I think number 1 is always, should I be purchasing some sort of asset before the end of the year, whether it be inventory, feed, chemical, a truck, security cameras, you name it. And really, I normally lean towards, if your business needs it, then buy it. Don't let the tax tail wag the dog in order to run your business. But also, there are some benefits to maybe waiting to buy it with tax rates potentially going up in the future. I always like to caveat with the law is not final yet. So I don't have a crystal ball. We think tax rates are going up, but I don't know what they will be in a month. I think the second one I probably get the most is regarding like-kind exchanges disappearing. I seem to have gotten that one a lot lately. Once again, it's looking like they'll still be intact for most clients. If you're dealing in really large commercial real estate, it's probably not going to be available to you anymore, but the option will still be out there if you're thinking about doing, residential rental properties, things like that. And then I think the third question I get is normally about tax rate increases, how tax brackets work, which I think we've referenced that already. And then if you have questions of what should I be doing at the end of the year, what sort of planning should I be getting together, I don't even know where to start. I think the best way to start is by giving us a call. We can kind of walk you through some of the options that are available to you, see if they fit your needs, and then you can move forward from there or decide, you know what, I'm good to go. I feel fine right now. That was a great conversation with Jordan. I was confused by Bill. Let's move forward.
That was a joke.
It was a joke.
I think that I can't disagree. Once again, the like-kind exchange, just so we're clear, there was a prior provision where aggregate capital gains in excess of $1 million, and then in total, then you would not be able to do a like-kind exchange at all. That provision is not in any bill right now. So to Jordan's point, you can still do like-kind exchanges, period. If you have appreciated property in an entity, it is the entity that does the like-kind exchange, not the owner of the entity. So I agree with Jordan. You should give us a buzz so we can walk you through the traps. There's some things called qualified intermediaries that are necessary. The number one question I feel like I get a lot of is, hey, can I still give charitable contributions? Are there limits? No limits on charitable contributions. So then the second question is, we keep hearing you talking about these charitable lead trusts. What's the difference? The thing that I love about charitable lead trusts are that first of all, it's a fixed term trust. Second of all, I get to take a current tax deduction for funding the trust, and I've spent no money. When I fund the trust, then the trust is mandated under the trust agreement to make X amount of charitable contribution payments to a list of charities every year for the next however long the trust goes. So if you have a trust, okay, if you have a charitable lead trust that lasts for 5 years, at the end of the 5th year, whatever money is in there goes where it's supposed to. So if you have a charitable lead trust and at the end of the 5th year, it goes into an irrevocable trust for the benefit of your spouse or for your children, it did not use your estate exemption. Kind of an interesting thing. The kicker with that is most of my clients that are doing them are so young that having it go into an irrevocable trust for somebody else out of their control is probably not the right direction right now. So the great thing about the charitable lead trust is if I want to give away $200,000, I can do it by placing corpus in an instrument. And if it's, let's say it's 50,000 a year for 4 years, I haven't even spent the 200,000, but I get a tax deduction for it now, as opposed to if I put it into a donor advised fund and I want a $200,000 tax deduction, I'm putting $200,000 in it and it is completely out of my control. So those are the fundamental differences. They're both terrific avenues. Our recommendation on lead trusts are, if you're not going to make annual contributions of 40,000 or more, probably go to a donor advised fund. If you're looking for those more material, larger, over $40,000 and over, then a charitable lead trust can make a lot of sense. So let's see. And that's really, I think that those are the top questions. Go ahead, Catherine.
Bill, we did just get another question in. If you have a large capital gain and mutual fund, do you get out or do you take the distribution and reinvest?
So if you have a large capital gain, now is this a capital gain distribution coming through at the end of the year, or is this an unrealized gain? Okay, so if there's a built-in unrealized gain, then I can give the mutual fund to a charity and get the charitable deduction for the fair value. Okay, if in December, the first couple of weeks in December, I'm getting capital gain distributions coming through, that's really the mutual fund company truing up all their accounting and harvesting stuff. There's not a lot I can do about it by then. The only way to not have to pay tax on that is to not be in the fund when it hits. So theoretically, the value of the fund has increased throughout the year. And then when I get out of it, I'll have this unrealized capital gain that is also supposed to be reflective of the capital gain distribution, reducing it back down. That's kind of the theory behind it. But if you have an unrealized gain in a value, in a position, okay, then the gift of that stock, you get the tax deduction for the high rate, but not pay capital gains. Is that answering the question, you think, Catherine?
I think you answered the question just with kind of how the mutual fund valuation would work, just how a stock would work with it. If it's expected to pay a dividend, it's going to increase. Once it pays it, it basically will decrease by that dividend amount in theory.
That's the norm. That's the norm. That's exactly right. Good questions. Good questions. Any other questions?
It doesn't look like we have any at this time, but if this webinar sparked other questions for you, or if you'd like to call and schedule an end of the year planning call, we're scheduling them right now with Blake, Jordan, and Bill. So if there's something you'd like to talk to someone about, we'd really like to talk to you. So just give us a call, or you can even respond to the email that you got from us and we'll get something set up.
Yeah, I would just take that and say one little thing. What is an end of year planning call? Well, really what it is what are your questions? What's your position? And then we can help you figure out what's my best after-tax cash flow. What should be the plan for this? We're happy to have those. We enjoy those.
I would say too, Bill, as someone who never knows what they're supposed to be doing with planning or what that even means, like if you want to have that conversation too, give us a call. We can set it up and maybe give you some tips on like what we would see as some starting points for you as well.
Absolutely. Absolutely. No question. So Jordan, last thoughts.
Last thoughts are, if you enjoyed this webinar, I encourage you to come to the one in December whenever hopefully we have laws that have passed and can be a little bit more informative on the prospective taxes.
Absolutely. Catherine?
Nope, that's all. All
right. I want to thank everybody for joining us today. If you do have questions, please reach out to us. We do want to help. We love working with you. It's one of the fun parts of doing business with our financial advisors. It's just that face-to-face or one-on-one collaboration. So love to help out in any way we can. And we look forward to seeing you first week in December. Have a great afternoon. Yeah. There you go.